Welcome to the lesson. In this lesson, we will get to know the inventory turnover ratio. We will know what is inventory turnover ratio and what information we can get from it. It is a very small but important topic in analyzing the efficiency of the business and whether to invest in it. So, inventory means the products that the company will sell and the raw materials that have been used in the making of these products. The inventory turnover ratio therefore tells us that in a fixed duration, how many times the inventory has been sold by the company. It is calculated as cost of goods sold divided by average inventory. Let us now understand what is cost of goods sold. So company, every time it sells goods, it incurs a certain cost. We need to find out what is that cost, and then after that we also need to know the average inventory. For that we need to know the opening inventory, that is inventory in the beginning of the year, and the closing inventory, which is inventory at the end of the year, and then take out its average. Let's understand this ratio with the help of an example. We take a company called X Limited. Now supposedly during the year 2022, the inventory at the beginning of the year for this company was 2 crores, and at the end of the year it was 3 crores, and the cost of goods sold for the company was 40 crores. So the first step that we are going to do is find out what is average inventory. So it will be 2 plus 3 divided by 2 is equal to 2.5 crores, and then after that the inventory turnover ratio will be cost of goods sold divided by average inventory, and that comes out to be 16, which means that in 2022 X Limited sold its inventory 16 times. Inventory turnover ratio shows how fast the products of a business are being sold. Before taking investing decision in any business, we should compare and analyze two businesses in the same industry. For example, in the slide we have taken FMCG industry into consideration, and under that we have taken HUL and ITC as examples. As you can see, the inventory turnover ratio of HUL is 13.67 times and that of ITC is 6.13 times, which means that HUL is faster in selling its products than ITC and obviously better in inventory management. However, that is not the only consideration for a better investment. When we are taking an investment decision, we should also see other aspects. Inventory turnover ratio is just one of them, and of course an important one. Sometimes companies tell their inventory turnover ratio in the form of days. We saw that X Limited had inventory turnover ratio of 16 times. So if we have to convert it into number of days, we are going to divide 365, which is number of days in a year, by the inventory turnover ratio of any business. So in this case it's X Limited. So we will divide 365 by 16 and we will get the answer as 22.8, which means that X Limited took 22.8 days to convert its products into sale. Based on whatever you have learned till now, you need to convert the inventory turnover ratio in the number of days for Hindustan Unilever Limited and ITC Limited. Let us now know about DSCR or debt service coverage ratio. It's one of the most important solvency ratios. I will take you through its meaning and how does it help us. DSCR is a very common term used by the banks or any lender when a business is applying for loans. The banks or lenders want to know how much comfortable is a business to make debt payments. That is, whether the business will be able to pay back the loan it is applying for or any other pre-existing loans it already has along with the interest. So, the major premises of DSCR is that can a business afford to take the loan it is applying for? The bank will study the cash flow and DSCR to know if they can pay back the loan on time with interest. Is your business net operating income more than the debt you have to pay back? Let us now understand the DSCR formula. It is profit after tax, in short PAT, plus interest obligation, plus depreciation, plus amortization, the entire sum divided by the debt service. The debt service includes the principal amount of the loan plus the interest expense and any other committed cost the business has, like a lease expense. Some of the important things that have to be kept in mind is that principal part of the loan is a non-tax deductible element. That is, there is no tax benefit on that. Therefore, in the numerator, the profit should not also have the tax element, and that is why we consider taking profit after tax. Also, depreciation and amortization are added back to the profit after tax because they are non-cash expenses. That is, they reduce the profits, but the business has actually not paid cash. So the cash remains with the business, and the banks are of the view that this cash will also be available for the payment of its liabilities in case the business is not able to pay the loan. So, how do we analyze DSCR? Any debt service coverage ratio which has a value higher than 1 will mean that the business has more than required cash flow. That is, its cash flow is more than its debt service and it is in very comfortable position to pay back its debt obligations. If a business has debt service coverage ratio which is equal to 1, it means that it has a cash flow which is equal to its debt service. It is not a very comfortable position, but it is not also a very bad indicator of the solvency of the business. Then after that, the last one is if the debt service coverage ratio is less than 1, it would mean that business is not able to generate enough cash flow to cover its debt obligations, and the lenders will definitely refuse to grant loan to such businesses. Most lenders, to be able to play safe, will always prefer debt service coverage ratio which is above 1. Let us understand the concept of debt service coverage ratio with help of an example. We take a case of a business whose profit after tax is rupees 56 lakh, interest is rupees 20 lakh, depreciation and amortization are rupees 10 lakh, debt is rupees 30 lakh. So first we will find out net operating income, which is sum total of profit after tax, interest, depreciation and amortization. So net operating income will be equal to profit after tax 56 lakh plus interest rupees 20 lakh, depreciation and amortization rupees 10 lakh, total is rupees 86 lakh. Debt service will include the principal and interest element of the debt, which is 30 lakh plus 20 lakh, 50 lakh. And then after that we will find out the debt service coverage ratio, which is net operating income divided by debt service. So 86 lakh divided by 50 lakh, answer is 1.72, which is greater than the value 1. So this means that the business has more than sufficient cash flow to be able to meet its debt obligations. However, in future, to be able to request loans and get them approved, it has to maintain this financial position. Let us now understand the benefits of debt service coverage ratio. Any business who has a higher debt service coverage ratio definitely has better chances of qualifying for a loan, because any bank would definitely consider a higher DSCR before approving a loan. Also, it gets favorable terms and conditions, maybe a lower interest rate while it is taking a loan. And any business who has a good debt service coverage ratio is able to manage its debt obligations in a better way and without any financial pressure. With this, we will also try to understand what are the simple ways of improving the debt service coverage ratio. One is that the business has to focus on increasing its revenue stream, amount of revenue. Also, it needs to cut down on its operating expenses, maybe cut down on staff, maybe cut down on its rentals, and also the third is it needs to decrease its financial obligations. That is, it needs to decrease its borrowings, its debt obligations. These are few ways in which the business can improve its debt service coverage ratio.